I'm just gonna put the information, well, I don't think we need a camera, I mean, so. Good afternoon, we're gonna get started in a minute. It's the time to make sure people are in. And for folks that have joined, please unmute your camera so we can see you. All right, so it is officially 1:25. We have people in the waiting room. I'm gonna take just one extra minute. All right. Good afternoon, everybody. Welcome to AC 221, section H1. We gonna get started, but first and foremost, can you guys hear me okay? Okay. And also one more thing. If you are in questrom, I just want you to know that you're not gonna have a good connectivity experience because for whatever reason, at least this morning, there was, the connection within questrom was horrible. I had a class this morning at 8 o'clock and a lot of us were kicked out of the system, and the class before you guys, the moderator was pretty much like trying to restart the Zoom all the time. So if you are in questrom, I think you're better off to join us in the classroom. Otherwise, I think you should be fine. Not sure what's happening, but if you have any connectivity issues, please feel free to let me know at any time. All right, having said that, I posted on, and I sent you an email about it, I had posted a handout with all the transactions that we were supposed to go through on questrom tools, and I asked you to take a look at them and try to do some work on your own so that we could, discuss it in class. So what I'm going to do is start, and today we should be able to wrap up chapter 2. So next class we'll start chapter 3. So I think your homework, just in terms of reminding you things and due dates, I typically do not remind students about homework in a sense that it should be part of your habit, but your homework are posted and are due on Saturday. So keep that in mind. And another reminder, office hours are tomorrow 2 to 4. For some reason, some of you try to, because I see it on Zoom, some of you try to call in on Tuesdays 2 to 4. Tuesday is 8:30 to 10 o'clock, and it's just for people that are overseas. So I just wanted to clarify that, because I saw a few people connected. Anyhow, having said that, let's dive into our material. Unless you guys have any questions. Okay. So recording transactions, that's what we're doing. Just to do a recap, again, we have assets. We have to satisfy the following, the conditions of assets equal liabilities plus equity, a change in assets equal to a change in liability plus equity, and then debits equal credit at all the time. And the other thing that is important to note is that debit means left and credit means right. This morning in another section, one of the students said, so debit is an increase, right? Not necessarily, because basically debit, it can be an increase depending on the account that we're talking about. So before we go there, let's think about a good form for journal entries. The debit the debit of the entry is typically reported before the credit. So in a journal entry, the debit would come first, like as you have it over here. And the credit is slightly indented and there is no negative balances. So that's something to keep in mind when we think about journal entries. Then as we, to answer the question, debit is increased and credit is decreased, here you can get a sense, and again, I'm gonna go somewhat fast on those just because we have done, went through this concept last class. Assets increase by debit and decrease by credit, but the liabilities do the opposite. So we cannot make the assumption that debit equals increase, because then you're going to have the whole accounting system incorrect in your head. One thing that can help you, though, to understand increases and decreases is this little slide, which is the slide of normal balances, where normal balance is what's a typical balance of those elements of the financial statements. And the typical balance means that what is the amount that is higher? So the amount that is higher is like, it's the amount that typically makes the account increase. So normal balances for assets, dividends, dividends, expenses, losses, and contra liabilities is debit. So assets, dividends, expenses, losses, and contra liability account typically increase by debit and have a normal balance, a natural balance on the debit side. Liabilities, equity, revenue, gains, and contra assets increase by and typically have a normal balance on the credit side. So keep that in mind when you think about transactions. I would think this slide might be useful for you to keep handy as you go into, the following courses like AC 222, because in essence, what this does is it gives you a way of, remembering like the mechanics, just looking at one single slide. So hopefully it helps. The other thing that I have posted for you guys was a handout, like a blank handout that you can use to record transactions. And then I've given you like the transactions with the empty sort of spaces, blank spaces, so we can plug in the transactions. So with you guys, I think we got to transaction number 4. I'm just going to pull that up. We did transaction number 4. Transaction number 5, again, this comes from the transactions that we have done in the first part of the chapter, which are to demonstrate the accounting equation. And transaction number 5 was a transaction where the owner of rent would purchase a car with her own personal funds, which doesn't create any transaction. So we're not spending any time on that transaction. So we're gonna start from transaction number 6. And I'm gonna pull up the document camera so we can do that transaction and the following transaction together using, like I said, the document camera. Now, when I use the document camera, I would like you to tell me if you can see my writing, if you can see the document camera. Again, I don't know about you guys, but this is the very first time in my life that I teach hybrid. So, and I apologize if I keep going back asking you if you can hear me, if the technology works, but that's the only way I have to sort of communicate for people that are not here with me. All right, so transaction number 6. On December 6, 20X1, RET pays $100 to employees for work performed in the current period, December. A wage liability was not previously recorded. So, keywords over here. Like if you had to explain it to your friend who's a major in philosophy, philosophers are great critical thinkers, but they know nothing, rightfully so, about debits and credits. So first and foremost, you have to attempt to explain what's happening in the financial statements to your friend. And so RET pays $100 to employees for work performed in the current period. And then there's a period there. That, to you and me, means that RET had a cash disbursement to pay salaries for $100. So RET cash in the financial statement must have gone down. Here, the second part is slightly more tricky because, again, like you guys are, what, week 3 of accounting? So, but it says a wage liability was not previously recorded. That means that RET is gonna book directly the wage expense because there was no accrual for liability, and we're gonna spend tons of time talking about accruals on Friday. So, but with that in mind, we know that RET had a cash disbursement and had to book an expense. Also, I mean, remember, I'm gonna try to make sure that I can keep in the conditions here, but remember the condition, hold on, I'm gonna find the blank here. The conditions that have to be satisfied: assets equals liabilities plus equity, a delta in assets equals a delta in liabilities plus a delta in equity, and then my debits have to equal my credit, and also normal balances, assets, dividends, expenses, losses, contra liability accounts have a balance on the debit side and increase by debit. Liabilities, equity, revenue, gains, and contra assets accounts stay on the debit side. So I'm gonna keep this mnemonic, like these information handy over here. I think you guys can see it to some extent. Here you go. And think about what to do with this transaction. So again, so what happens to my cash? Goes up or down in this transaction? Anybody? Keyword, guys. I mean, you don't have to know accounting. RET pays 100. What happens to cash? Cash goes up or down? Down. Okay, great. Thank you. Thank you so much. So cash goes down $100. And then I have to book an expense, right? So if I book an expense, I have to think about this. So my equity has 2 components. Paid-in capital plus, for now it's 2 components, guys, because the equity has more than 2 components, but paid-in capital and retained earnings. Retained earnings is cumulative net income minus cumulative dividends. Cumulative net income has two components on its own: cumulative revenue minus cumulative expenses. So, is it fair to say that when my revenue goes up, my net income goes up? When, however, on the other hand, if my expenses go up, my net income goes down. Because my cumulative expenses will reduce the net income. And so my revenue go up, my cumulative expenses go up, my retained earning goes up, my equity goes up. My expenses go up, my net income goes down, my retained earning goes down, my equity goes down. I tried to do it color coded, and I think you guys can see it, the pink and the blue. So here I don't have a space for expenses. I have a space for equity. So here I'll put over here wages expenses. How do I book that wage expense? As a positive or a negative? To show the effect on the equity. Negative. I mean, it says it also on the note over here. Excellent. Now let's go and look at the debits and credits, okay? So debit, I have cash. Cash as a balance in the debit side, but cash is decreasing. So how do I book the cash? As a debit or a credit, guys?
Credit.
Credit. And you guys feel free also, if you want to participate, feel also free to unmute. So cash gets credited by 100. Wages expenses is increasing. An increase in expenses decreases cumulative net income, decreases retained earning, decreases equity. So I have to book, obviously, the debit of wage expenses that is increasing by 100. Now, if I have to look at my T accounts from previous transactions, I have 21,000 on the debit side, and then I'm gonna have 21,000 on the debit side, 5,100 on the credit side. So that will be what? 14,900. 14,900. Whereas on the expenses, it's 100. No, 14,900, yes. Okay. Yes.
No, like 15,000.
15,900, you're correct. Yeah, there was something else. So one thing that you need to know about me, when I do calculations, I have to do it without anybody. Otherwise, I get confused. Ironically, that's why I write down all my calculations. So, all right. So then I'll have a balance of cash of 15,900, and then a balance of wages of 100. All right. So, I mean, we spent a lot of time in this transaction just because it was sort of like, for us, a way to dust off the concept from last class. Now let's try to do transaction number 7. 1 second. I have it in, I don't know, where is it? Here you go. Okay. Sorry, I'm going to put the 7 because I need to cut the pages. Here you go. Okay, so transaction number 7. On December 7, 20x1, Red paid the 200 for supplies previously purchased on December x1, on December 3rd x1. So first and foremost, like pays 200, that means that I'm going to involve cash. And then what's the other account that I'm gonna be using?
Accounts payable.
It was for supplies previously purchased, yes. And you have it also at the bottom, I'm sorry, accounts payable. So remember the information that we have over here. Sorry, this is a P. So cash will go down 200. Accounts payable will go down 200 because now I'm paying. So if I'm looking at my debits and credit, cash will go, accounts payable will be debited. Remember, accounts payable is a liability. Liabilities increase by credit, hence they decrease by debit. So accounts payable will be decreased by 200, cash will be decreased by 200. And here, I'm gonna have, here you go, the 200, I'm gonna plug it in the debit side, and I'm gonna plug, I'm on the credit side, and I'm gonna plug on the debit side the 200 of accounts payable. So that's how I do the transaction. So again, my cash is reduced, so it's credited. My accounts payable is reduced, so it's debited. Here, I'm carrying the balance of cash, which now is 15,700. In the accounts payable, my balance was 300 because supplies were 300. The purchase of supplies was 300. I paid only 200, so now I have left 100 of supplies. Any questions before we move on? Okay. So, let's list the pages. 11, 10, 9, 8, here. So, okay, so transaction number 8. On December 28, 2021, Red sold inventory to a customer on account. So you almost want to put like, okay, this is one piece of information. The inventory sold originally cost 300. So remember, when we have an inventory, like a sale on inventory transaction, we have 2 steps. Step 1, we book the sale. Step 2, we book the decrease in inventory, increase in cost of goods sold. This is an S, believe it or not. So, Red sold inventory to a customer on account. What does that mean? Do I have a sale? Yes or no?
Accounts receivable?
So my accounts receivable will be involved and they will increase by 400 because accounts receivable is no cash exchange. Hence, accounts receivable. So my accounts receivable tell me how much clients owe me for sales that they haven't paid me for. So when we have on account, a sale on account, there's no cash exchange, therefore we use the account of accounts receivable, which is an account of the assets. Now, if I want to book the sale on account, which is different from what we saw from the other transaction number 4, there was a sale on cash. So if I want to book a sale on account, here I have an increase of accounts receivable, and what else increases for sales? What is the other account that increases when I have a sale?
Revenue?
Revenue. Thank you, Vanessa. Okay, revenue goes up by 400. I book the revenue as a positive because remember, revenue increase the cumulative net income, increase the retained earning, increase the equity. It's a cascading effect. All right. So that's my step 1. Step 2, book the decrease in inventory and increase of cost of goods sold. So my inventory decreases by 300. Why the inventory decreases, guys? This seems like very trivial, but you know, we need to sort of make sure that we are on the same page on that. Why does the inventory decrease?
Because you sold it, so you no longer have it.
Because I no longer have it, I sold it. And my cost of goods sold increases, hence decreases the equity by 300. Sorry, I forgot the parenthesis here. Because the cost of goods sold will show how much costed me that sale that I made. How much costed me that piece of that inventory that I sold for 400. And so that's your step 2 of the transaction. Now, with that in mind, and keeping our little mnemonic always in mind, for the first step of the transaction, what do I debit and what do I credit? So for the increase in accounts receivable and increase of revenue, knowing that assets increase by debit and revenue increase by credit, what do I do? Yes, go ahead.
Debit, accounts receivable.
I would debit accounts receivable by 400. And what else?
You would credit gain on sale of inventory.
I'm sorry, I can't hear you.
You would credit gain on sale of inventory.
I would credit inventory?
No, gain on sale of inventory.
Oh, well, gain on sale?
Yeah.
We don't have, so gain on sale is a different concept. Gain on sale typically is a concept that is an account and a concept that we use when we sell, say, a piece of equipment at a value that is higher than we have a bucket for. So I have a piece of equipment for that is worth $1 million, and I sell it for $1,050,000. My gain on the sale of that equipment is $50,000. But here it's just a straight revenue, straight sale. It's not a gain on sale, because gain on sale is a very specific concept. So I will book the revenue or sales at 400. Then what do I debit and what do I credit to show a decrease in inventory and an increase of cost of goods sold, guys?
Debit.
Cost of goods.
Okay, I debit the cost of goods sold. Did somebody else, Christina, was it you?
Yeah,
What did you say?
I said debit cost of goods sold.
So you would debit the cost of goods sold because the cost of goods sold is increasing. And I would credit the inventory, which on the other hand is, I'm sorry, is decreasing. Okay? So I have 700 debit equals 700 credits. And if I go here at the bottom, I will increase my accounts receivable by 400. I will decrease my inventory by 300. So this is 4,100. I would increase my revenue by 400. So this is 1,400. I would increase my cost of goods sold by 300. So this is 900. All right, any questions? So transaction number 9. You want to save the planet and you make, and you print double-sided, but then it becomes a very difficult exercise to find the pages that you need. All right, transaction number 9. On December 9, 20X1, Red purchased 2 trucks for $9,000 each in exchange for 18,000 note. Like, so as opposed to pay in cash, Red issued a note saying, I will pay you later, I'll issue a note payable. So there's no cash exchange over here. But again, if you have to go back and explain it to your friend who's majoring in philosophy, what would you say is happening in the financial statement? What's the story? Yes, go ahead.
You're borrowing money to buy a truck, or buy
I'm-
two trucks.
Right, I am borrowing money to purchase 2 trucks. So in my financial statements, now I'm gonna see 2 trucks for a total of $9,000, of $18,000, and I'm borrowing money, so I'll see a debt, I'll see a liability of 18,000. So how do I translate that? Trucks are assets, guys, and they will go up by 18,000, and notes are liabilities, and will go up by 18,000. Using the mnemonic that we have over here, I suppose we can safely say that my trucks account will be 18,000 in the debit, and my notes payable account will be 18,000 in the credit. So my balance of the trucks is 18,000, which is a normal balance in debit. 18,000 of note payable. And that's easy. I mean, that's an easy transaction over there. All right? We're gonna come back to this transaction to see part 2 of this transaction. All right, number 10. Collect cash for sale made on account. So Red collects $350 for sale made on account on December 8x1. So collects $350 for sale made on account. If you had to explain it to someone, what does that mean? A customer was owed you money. After you collect the $350, does the customer owe you that $350 anymore? No. You guys are shaking your heads. No. So what happens to my cash? Does increase or decrease?
Your cash would increase $350 and then your accounts receivable would decrease $350?
Correct. So my cash, which are both assets, my cash will increase by $350 and my accounts receivable will decrease by $350. So that means that my cash will be debited by $350 and my accounts receivable, remember, it's an asset, increases by debit, decreases by credit. My accounts receivable will be credited by $350. So if I go down here, my cash will go up by $350. My accounts receivable, they used to be $400, will go down by $350. And I believe at this point, this is what, 20? No, it's not 20. It's, hold on one second. I just want to make sure that I do the math right, because I'm pretty notorious to mess up. 20 plus 1 plus 0.350 minus 5 minus 0.1 minus 0.2. My cash is 16,050. And my accounts receivable left is $50. So that's what it is at this point. Okay, so let's go quickly on transaction number 11, which sort of entails the concept that I think Manav was trying to get to, which is the gain and losses on sales. So here we have a situation where on December 11, 20x1, Red sells 1 truck for $9,000 cash. So, I mean, if I sell for cash, my cash will increase by $9,000. And again, the transaction is no gain or say a loss. So my assets, trucks, will go down by the $9,000 because I'm selling that truck. But let's say that, a truck was $9,000 and I sold that truck for $10,000. Man, and everybody, that would have been the situation where I would have had a gain on sale. The gain on sale is really the delta between how much you have an asset, long-term asset in your books versus how much you sell it for. It is not the revenue. It's a different concept. It's a concept where you have an asset, you keep that asset, and then you sell it, not as part of your daily operations, but as this is an non-operating item, and then you make extra money. So in this case, again, if you had sold it for $10,000, your gain would have been $1,000. And we're going to talk extensively about the concept of gain and loss. Conversely, if you had sold it for $8,000, you would have had a loss of $1,000. So in this case, my cash increases by $9,000, and my trucks, which is assets, decreases by $9,000, so I book it as a credit. So if I go here, then I have 9,000, and then here I will have, I'm sorry, 9,000, so this will be, what was it, 16, what is it, 25,050, I believe. And this was 9,000 negative, so my bottom line is 9,000. Okay? So I decrease my truck, and now my truck are 9,000. The last, any questions before we move on? Okay, the last transaction is dividend payment. So on December 12, 20X1, REC declares and pays a 75-cent dividend. So I'm going to go back just a second, guys. I want to show you what we were talking about before about dividends and about the decrease on revenue and so on and so forth. So remember, we were talking, here you go. Okay. Remember, we were talking about what happens in the equity. So I'm going to add the new color, which is going to be red. No, it's going to be green. So remember, what happens to the equity? If I have a dividend, if I have an increase of dividend, just because retained earnings is cumulative net income minus dividends, if my dividends go up, my retained earnings, goes down, my equity goes down. So I have to keep that in mind for this purpose. So if I declare and pay a dividend, that means that my cash increases or decreases, guys?
It decreases.
Decreases by 75. And then what happens to the equity? Remember, my dividends increase, my equity is gonna decrease. Because the dividends decrease the retained earnings, because they are it's like giving away a portion of the retained earnings to stockholders, and therefore decrease the equity. So I'll put the dividends, and I am going to show the effect of decrease on the retained earnings. So dividends, when they increase, they get debited. So 75, cash reduces by 75, and here I have a reduction of cash of 75, an increase of dividends of 75, so that is what, 24,095, I believe, and this is 75. So that's my situation. Those are my journal entries. Now I'm going to go back. Any questions before we move on? So we've done all the transactions. Now, what we're gonna do is to go back to our exercise and try to build a financial statement. So I'm gonna scroll again, like if you go into the slides, you see that here I have all the accounts, and so you have the ending balance of cash, the ending balance of accounts receivable, the ending balance of inventory, that's your EB. And here the ones of the other accounts, which then get summarized into this. Oh, I'm sorry, it was 24,975, not 095. So the balance of cash. So I had a beginning balance of 0, which was like at the time I have created my company. Then I have prepared all these transactions, and here's my ending balance, which I can use to build my financial statements now, which is great because it's something that you can do with 1,000 of transactions, or even with like a very discrete number of transactions, such as 12 transactions. So if I want to, before I want to do, I build a financial statement, there's a document that is like a summary to build a financial statement. It's the trial balance. It's a summary of all the accounts, and it actually helps you to prove, first of all, that the assets equal liabilities plus equity, but also that debits equal credit. And so here's how the trial balance for this company would look like. You have a debit of 39,500 equal a credit of 39,500. This seems like a trivial exercise, and you're like, well, okay, that's fine. What other use I have for this? Trial balances are extremely important, guys, because they help you figure out, do you have all your normal balances where they are supposed to be? So said differently, say I have an accounts receivable that is on credit. Well, that's not right. I was making this example this morning. It is absolutely not correct, because if accounts receivable is on credit, it means that I owe to the customers. So either is the result of, somebody on the chat. Either is the result of something that went wrong, and I have to go and check my transactions, or could also be the result, which is very common, and that's why I brought this up, of having a customer/vendor relationship with the same entity. Say Verizon. Say I have Verizon as a customer because I make equipment and Verizon buys my equipment, but I'm also a vendor of, I have Verizon as a vendor because Verizon provides me all the phones, all the lines of my office, but I also have Verizon as a customer because Verizon purchases equipment from me. If I have an accounts receivable in the credit, means that my transactions with Verizon as a vendor are higher than the transaction as a customer. So I have to take that balance of accounts receivable credited, and I have to reclassify that as accounts payable. So that's why it's important to look at a trial balance to sort of investigate those outliers here of what should be debited instead of credited and vice versa. And it helps you also figure out if you made a mistake in the transactions. So having that available to us, now we can think about how do we build the financial statements. If you may or may not recall this slide, this is a slide from the previous, do you know what this is? Why this is happening?
Is it the slide itself?
Absolutely not. Sorry guys, I'm not sure what's going on. Let me stop sharing and sharing again.
Yeah. Weird.
Beyond.
Press escape first.
Okay, let's try again, okay? Oh, this is room 210. I teach auditing, guys, and sometimes I teach auditing between 4 and 6:45 on Wednesdays, and sometimes we have the most entertaining stories that keep us awake on room 310. Anyhow, so we first prepare the income statement, then we look at the retained earnings, then we look at the balance sheet, and then we look at and prepare the cash flow. So again, income, if we look at the income statement, is revenue minus expenses plus gain minus losses. So if I'm looking at my income statement, yeah, this is off. If I'm looking at my income statement, I have, and I want to build the income statement, I'm going to start looking at revenue for 1,400, cost of goods sold, minus wages. It gives me a net income of 400. And I'm going to keep that value because then I'm going to use it when I go into the statement of retained earnings. So I calculated the net income to be $400. Now I'm going on the statement of retained earnings, reminding myself that retained earnings increases the equity and then normal balance on credit. Revenue increase the equity, therefore have the same normal balance. Expenses decrease the equity has the retained earning, therefore have a debit balance as a normal balance. And dividends do the same. Now, retained earnings equals cumulative net income on cumulative dividends. So when the net income goes up, retained earning goes up. When retained earning goes up, equity goes up. So let's figure that out. So my net income is positive, will increase my retained earnings. My retained earnings beginning balance is 0. I have common stock issued of 20,000. Net income increases the retained earnings by 400. Dividends issued decrease the retained earnings. Therefore, the ending balance of my retained earnings is 323. Now, I have calculated that balance of retained earnings. Now, I want to make sure that if I plug that balance of retained earnings into my balance sheet, that's going to work, and my assets equal claims will work as an equation. So let me build a balance sheet. The balance sheet. I have all the assets, the liabilities, and if I plug retained earnings of 325, my assets will equal my total liabilities plus stockholders' equity. So that 325 is an accurate number and has two components, net income minus dividends. You know, for the fun of it, I'm gonna do the cash flow, which will show that I have a change in cash from 0 to 24,975. So I'm all set with all the financial statements. The only thing is I need to figure out how do I make that retained earning balance now to be 325? Because I still have revenue of 1,400, cost of goods sold of 900, wage expenses of 100, and dividends of 75. And my retained earnings in my accounts is still 0. I have calculated to be 325, but I have to figure out how to make it 325 in my accounting system. I do that using closing entries. Closing entries are a way, like I said, of updating the retained earning for the impact of the net income and the dividends. They reflect the activity in the statement of the statement of cash flow. And what closing entries do, they zero out the temporary accounts, which are revenue, expenses, gain, losses, and dividends, because those accounts at the beginning of the following period have to start from 0 to keep measuring the performance of the company over a given accounting period. If you don't know what I'm talking about right now, please go back and review what we talked about in chapter 1. This is the time to catch up, guys. So permanent accounts are all the accounts of the balance sheet that carry the balance over. My balance of assets is not going to zero out because my balance sheet is a point of time information which will tell me how much assets do I have at any point of time. Same thing for liability, contributed capital, retained earnings. Temporary accounts are the ones that change retained earnings. And they zero out because their function is to show the performance during a period of time. They tell us a story. The income statement tells us a story, And the dividends, separate from the income statement, because the dividends are not part of the income statement, obviously, tell us a story of how many dividends the company has distributed in a given period of time. So, with that in mind, I have my closing entries that have the function to update my retained earnings. I have to reset revenue, cost of goods sold, wages, and expenses to 0, so I can get started with the following period. So what I do is to reset them, I zero them out. How do I zero them out with a mechanic standpoint? Revenue has a credit balance. I debit the revenue. Cost of goods sold, wages, expenses, and dividends have a normal debit balance. I credit them. The delta between the amount of revenue and the ones of the amounts that I credited is going to be what's going to be left to be moved into the retained earnings, which is 325. Which, if you go back to the statement of retained earnings, is going to be increase for the net income of 400 minus the 75 of dividends. So the plug between the two, between the debit and credit, is going to be the amount that is going to increase, or it could very well be decrease the retained earnings, depending if you had a net income or a net loss. Does that make any sense? So post closing, all these temporary accounts are zeroed out, and I move the net balance of all these accounts to retained earnings. Because if you do 1,400 minus 900 minus 100 minus 75 is going to give you 325. And that's what you move into the retained earnings. Does it make sense? So guys, I think major takeaways from here, and then miraculously, we're gonna end up pretty much on time here. Major takeaways. Please review the concept of, how do you build a financial statement? The concept of debits and credits. The concept of temporary and permanent accounts, and understand how the closing process works. If you understand debits and credits, the closing process is going to be second nature. And actually, it's a fun process because ultimately everything has to tie. All right, so what I'm going to do is to post the slides of chapter 2. As I've done it for chapter 1, there's going to be more slides than what we presented, just because there are other items or like fun facts that I include into the slides. We all include into our slides. And also, there's a very nice appendix, which I would like you just to skim through, so to learn additional concepts that I think they're very useful. But again, we have just so much time, and we cannot present everything. So again, you'll find the slides of this class posted under individual class meetings, and then the whole chapter posted under questrom tools as well. And as soon as the queue is free, the recordings will pop up. Please remember about the homework. We'll see you on Friday unless you have any other questions. Thank you, guys.
Thank you.
Thank you.
Hi.
Hi, do you have a question, Emily?
I just wanted to apologize for my computer crashing halfway through class. That's why.
Oh, not a problem. I figured. I mean, I'm thankful that I was watching and I was able to unmute you again. So hopefully, it was a quick pause, but no worries about it.
Yeah, of course. Thank you so much. I just wanted to clear anything up I didn't.
Thank you. Bye, Molly. Have a good rest of the day.
You have a great day. Bye.
Bye.